The buildup to the Great Recession was marked by key economic indicators flashing red. Warning signs included an unsustainable housing bubble, excessive borrowing, and risky investments. These elements converged, creating a precarious financial environment ripe for disaster. Subprime mortgages played a pivotal role in triggering the financial crisis. Lenders issued these high-risk loans to borrowers with poor credit, betting on continuous housing market growth. However, when housing prices fell, defaults skyrocketed, sending shockwaves through the financial system. The collapse of Lehman Brothers marked a critical juncture in the recession. Its failure in September 2008 symbolized the severity of the crisis, leading to widespread panic and a freeze in global credit markets. This event underscored the interconnectedness of the world's financial institutions. The crisis quickly transcended national borders, evolving into a global economic downturn. Countries around the world felt the impact through reduced demand for exports, tightening credit conditions, and falling investment. This global contagion underscored the deep economic interdependencies across countries. Governments worldwide responded with unprecedented interventions to stabilize the economy. Stimulus packages aimed to spur growth, while bailouts were targeted at key industries and financial institutions teetering on the brink of collapse. These measures were critical in averting a deeper economic disaster. The Great Recession unleashed havoc on the housing market, leading to unprecedented foreclosure rates. Homeowners found themselves underwater, owing more on mortgages than their properties were worth. This wave of foreclosures not only decimated family wealth, but also destabilized neighborhoods. Subprime mortgages were at the heart of the crisis, luring in borrowers with the promise of homeownership, despite their inability to afford the loans in the long run. When these high-risk loans defaulted en masse, it triggered a financial catastrophe, highlighting the fragility of the banking system. Lehman Brothers' collapse marked a pivotal moment in the financial crisis, sending shockwaves through the global economy. Its bankruptcy underscored the interconnectedness of global finance and how vulnerabilities in one part of the system could lead to worldwide repercussions. The crisis quickly transcended national borders, affecting economies around the globe. International trade and investment took a hit as countries grappled with the fallout, revealing the extent of globalization's reach. This global downturn underscored the need for coordinated international response efforts. Government interventions, including stimulus packages and bailouts, were critical in stabilizing the economy. These measures aimed to restore confidence in the financial system, prop up struggling sectors, and mitigate the broader economic damage, albeit at a significant cost to public finances. Consumer confidence and spending took a significant hit during the Great Recession, leading to a vicious cycle of economic contraction. As job losses mounted and news of financial turmoil spread, households cut back on expenditure, further dampening economic growth and deepening the recession. Central banks around the globe responded to the crisis with unprecedented measures, slashing interest rates to historic lows and implementing quantitative easing. These actions aimed to stimulate borrowing and spending by making money cheaper, though the outcomes varied across different economies. Austerity measures introduced in several countries to curb public debt levels led to widespread protests and criticism. Reductions in public services and social welfare programs placed additional strain on those already reeling from the economic downturn, exacerbating social inequalities. The Eurozone crisis highlighted the fragility of interconnected economies, with peripheral economies like Greece, Spain, and Ireland facing soaring borrowing costs and severe recessions. The challenge of sovereign debt and the need for bailouts tested the solidarity among EU members. The Great Recession exacerbated income inequality, with the wealthiest individuals recovering their losses much quicker than the middle and lower income groups. This long-term effect has sparked debates on the need for policies that ensure more equitable economic growth and distribution of wealth. The Great Recession delivered a severe blow to small businesses and entrepreneurs, stifling innovation and constraining growth. With credit markets frozen, many small enterprises struggled to survive, leading to closures and layoffs, which further exacerbated the economic downturn. As the world grappled with the aftermath of the recession, lessons in financial regulation and oversight emerged as beacons of hope. Governments worldwide initiated reforms aimed at preventing future crises, focusing on more stringent regulatory frameworks to ensure financial stability. The road to recovery was paved with challenges, yet it also presented opportunities for economic growth and resilience. Nations slowly rebounded, driven by policy interventions, stimulus packages, and a gradual restoration of consumer confidence, marking the beginning of a long but steady healing process. The psychological and social effects of the recession lingered long after economic indicators began to improve. Families and communities faced enduring hardships, from lost homes and jobs to the strain on mental health, highlighting the deep personal impact of the crisis. In the face of adversity, technology and innovation became critical engines of economic transformation and recovery. Digital advancements and new business models emerged, offering solutions to some of the recession's most pressing challenges and setting the stage for a future of resilient growth. Comparing the Great Recession to previous economic downturns reveals a unique blend of causes and effects, particularly in the realm of global interconnectivity and financial innovation. Unlike earlier crises, the rapid spread of financial instruments, such as subprime mortgages and the subsequent collapse of major financial institutions, underscored the fragility of the global financial system. This comparison not only highlights the severity of the recession, but also the unprecedented speed at which it impacted economies worldwide. Looking ahead, the future outlook emphasizes the importance of economic resilience and preparedness. Learning from the Great Recession, policymakers and financial institutions are now more attuned to the signs of economic distress and the need for robust regulatory frameworks. This forward-looking approach aims to mitigate the impact of potential crises, ensuring that economies are better equipped to handle the challenges of an ever-evolving global financial landscape.